Hello and welcome to Halftime Report. I'm Sonia Shenoy and with me is Mangala Malu. Well, the market has sort of been all over the place. It could have been bad, but it's picked up quite a bit from the lows and now holding with a gain of 61 points. It's actually the best outcome because we had the US markets which were under a lot of pressure. We woke up this morning with red across most Asian market screens as well. FIs have been selling in cash for 6 straight days. So given all of that, this is quite a resilient market, you'd have to say. Of course, we also have HDFC Bank's numbers, which were very strong, and that led from the front. And this is a week of hectic earnings. So lots happening. There's HUL, ITC, ICICI Bank, and Reliance Industries that we'll end the week with. So we have our hands pretty full.
We have our hands pretty full, and just to know that the week has so many things makes you tired on a Monday itself. But to be very honest, it's a bit of passing the parcel that both the bulls and the bears are playing with each other. The Nifty, while it is resilient, we have the mid-cap index which are underperforming, and that has happened. The mid-caps have underperformed for the second straight session. And as HDFC Bank comes off the highs, another heavyweight supports the Nifty around that 17,240, 17,250 mark. We have Reliance. That has moved to the high point of trade. Remember, it started on the back foot. Reliance was among the losers on the Nifty and now has moved back into the green. So passing the parcel indeed.
But it's also the week before Diwali. So generally sentiment, energy levels, festivities are high. And I mean, nothing can dampen the spirit really.
Nothing can dampen the spirit.
In the Diwali week.
Yes, and because it's been so resilient, let's call it a firecracker Diwali this time around.
Wow, it's going to be fun, right? After many years, actually, Diwali is going to be celebrated in full spirit. I mean, we've come out of such a challenging time, so I'm really looking forward to it. And I'm sure the market is as well. But let's talk about some stocks then. It's definitely Diwali for Bajaj Auto. That stock is trading higher after reporting a decent set of numbers, no problems over there. But in our special segment value add, I'm going to tell you 5 reasons why Bajaj Auto is in the green today. First, of course, is the good set of numbers that they reported. So revenue growth of 16.5% despite all the challenges in the export market, 25% growth in EBITDA, and the margins up 130 basis points on a year-on-year basis. Now, the second reason is that this margin improvement is expected to continue as per what the management told us a while back. That's because the raw material cost, lower raw material cost impact will trickle into Q3 as well, and the export realizations have picked up. So let's just get a bar chart for you on the screen about how the margins for Bajaj Auto have moved over the last 5 quarters. They have been trending higher, and now, as you can see, at 17.2%, expected to move up further. The third reason is on the export front, where there are a lot of concerns about the slowdown in the Nigerian, African as well as LATAM markets. The management has said that the worst of the export retails is now behind them. Exports should improve quarter on quarter, and the strength in the export market will continue. And that's something that the street has definitely liked. Apart from that, you also have in the domestic market, the management has said that the September retail sales were better than July and August. However, demand is still muted in the festive season, and they're looking at a single-digit growth coming in for the industry in the domestic motorcycle segment. Finally, the brokerages, right? Most brokerages have either cut their target price or their earnings estimates. But the good part is that the target prices are still well above the current market price. So on an average, it's anywhere between 4,000 to 4,500, with Goldman Sachs being the most aggressive on the street with a target price of 4,500. So here's a word coming in from the Bajaj Auto management on the way forward for the business.
The reason for the export realizations to be better is a combination of 2 things. Primarily, it's a mix effect because the largest geography of Africa, which is generally the lower priced models which go there, that weight for that reduced. But on the other hand, our sales in our business in LATAM and ASEAN, the penetration or the market share and the mix of our higher end brands like Pulsar and Dominar, that improved. That aspect of the business will continue because we are having very good traction. In fact, all our new models are just about to be shipped, and they're going to be making an entry into LATAM and ASEAN. As you know, Q2 was a record-smashing quarter for us. We have achieved our highest top line and our highest EBITDA in rupees crores ever. Of course, it was aided by pipelining the stocks in the domestic market. But nevertheless, given all the stuff which was going around, it's a very, very delightful performance from our point of view. And going forward, our whole approach is to maintain both the top line and the bottom line and the profitability as we go forward. The demand in domestic is still muted. It is not negative, but it is very marginally positive during the festive.
All right, so that's about Bajaj Auto doing well. Management expects a good festive quarter for them. Max, there's an update coming in from our correspondent. It's a CNBC-TV18 exclusive. We'll just get some more data on that and get perhaps Yash to get us the details on what's taking place. It was an extremely volatile stock, Maxfin, on Friday's trading session on account of the news that came in with regards to the penalty and thereabouts. But let's move on. Shree Cement is the other stock which is on our radar, lower in today's trading session. That's primarily on account of the numbers, though it's off the lows of the morning, sitting with a cut of about 3% Nigel joins in with more details on the same. Nigel.
Well, Shree Cement's numbers go down as a miss, both on the top line and on the EBITDA front. The key reason should come up for you on the screen. On the volumes front, it was in line. The problem was in the product mix. So they sold a high amount of clinker sales, and also non-trade sales as a percentage of their mix, well, it was relatively higher. That perfectly reflected in their realizations, which contracted by around 9% on a sequential basis. The street was bracing for around a 5% contraction. To make matters worse, costs remain elevated. They were sitting on some high-cost pet coke inventory. Power and fuel costs as well as freight costs, well, they remain elevated in the past quarter. That led us to the EBITDA per ton coming in only around 700 rupees per ton. On a year-on-year basis, that would mean that the EBITDA per ton has effectively halved. What did brokerages make, though, of the stock? Well, you have Morgan Stanley. They have an overweight rating, though they've cut their target price to around 26,000 rupees odd. They expect the company to do well in this cycle, both on volumes as well as on the realizations front. Jefferies, they have a hold rating, though they have trimmed their EBITDA estimates. While Motilal Oswal, they have a neutral rating. They highlight the fact that stock is fairly expensive at current valuations. The management joined us here on CNBC-TV18 and said that they expect volumes to grow by close to around 10% for the coming year. They expect EBITDA per ton to improve to around 9 to around 1,000 rupees per ton. And they also added that they're not interested in the JP Group's assets.
All right, Nigel, thanks a lot for that. So that's Shree Cement. There's some margin pressure there. But Tata Elxsi is sliding in trade after a growth miss and margin compression in Q2. Reema's here with the fine print of how the numbers look. Reema, after a very long time, the growth has slowed down for Tata Elxsi.
Thanks so much for that. So growth for Tata Elxsi has come in softer than what the street was anticipating. Revenue growth on a year-on-year basis stands at 28%. Now this compares with close to a 40% growth that the company had about 6 quarters ago. In fact, for the last 5 quarters, the company's growth rate has been in excess of 30% and it has been steadily declining. And this quarter, it's dropped below the 30% mark. Constant currency revenue growth on a quarter-on-quarter basis too has now come in at 4.7%, which compares with a rough average of 7% over the last 4 quarters. The company said growth rates were impacted by supply-side challenges. Margins too for the company have seen a sharp drop of 310 basis points lower on a sequential basis, again below the 30% mark. The company has hired very aggressively because, as they said, they were impacted by supply-side challenges. So the net addition this quarter has been the highest number of employees that the company has added in a single quarter. It impacted utilizations and therefore the margins. Where did the company see pressure? In their media and communication verticals, both in US and Europe, particularly OTT players. On Europe, the management commentary in the conference call was that there is a slowness in new opportunities. No existing deals, cancellations or deferrals, but new opportunities are a bit slower. Customers are becoming more cautious and the deal closure times are also going up in Europe. The problem is this stock has been a rank outperformer, 45% up this year at a time when the rest of the IT sector have seen big stock plunges and valuations are roughly at 65 times forward multiple. So the margin of error is very low when it comes to Tata Elxsi. Back to you.
Welcome back. Let's get chatting with the management of Angel One. Reported a good set of earnings for the second quarter with the volumes coming in at all-time high levels. Remember, we did speak with the company when they reported their second quarter update itself. But now that the numbers are out, we have with us the CEO, Narayan Gangadhar, joining in. Mr. Gangadhar, thank you so much for joining in. You know, before we talk about your numbers as a whole. We have the operational numbers that came by 10 days ago as well. What I wanted to know is that the new payout rules came into effect last Friday itself. I mean, the first Friday of every quarter, all brokerages must be transferring all their unused funds back to customers' bank accounts. And this was expected to impact your working capital. Can you give us a sense of how this has, played out so far? It's early days still.
Yeah. So first of all, thank you for having me on the program. And I think these new regulatory changes, they are actually, they're actually going to be a tremendous value add for the whole ecosystem, because they are building the institutional credibility for the broking business as a whole. So all of these changes are more than welcome, and we fully embrace those changes. Now let's talk about this particular payout. So the payout happened on 7th, which is the first Friday of the quarter, and that's what it's going to be going forward. Now, for us, because we are completely tech-enabled, we use this as a catalyst to bring new experiences and new journeys live with our product. As a result of which, on the subsequent Monday, the very next Monday after the payout, we didn't see even a 5% drop in our business. We, in fact, saw that the total number of orders went up by about 4% relative to what it was on the Monday before. So what's happened is that these changes have served as an excellent catalyst for further pushing our digitization strategy, for further introducing newer journeys, which overall are going to strengthen the client experience. So, there you have it. We have live data from the last 6 days saying the money that went out came back within the first week itself, and we didn't see any drop in any order volume at all, even on the very next Monday.
Okay.
So,
Mr. Gangadhar, good afternoon. I wanted to talk a little bit about the revenue per client. So if you look at it on an average, right, the revenue per client has been declining. In the quarter gone by, you had about 430 rupees per client, and way back in Q2 of last year, it was almost 544. Now, I agree that competition is also picking up, but do you see any improvement here, or could it get worse before it gets better?
See, I think you're looking at the wrong metric, okay? This ARPU in a commodity business, broking used to be a boutique business. It used to be only for people who are over 35, who have a certain level of disposable income and stuff. Today, broking is for masses. Most people who are entering the business today, they're basically within the age of 25 to 30. So as the market has rapidly expanded, the volumes have gone up. If you look at the volumes that we have reported this quarter, we are at 228 million orders, which is our all-time high, which is also a significant jump over where it was in the previous quarter. So in terms of ARPU, yes, as more and more people come to the market, yes, the actual unit number is going to trend downwards. But as a whole, as a business, we are only going to continue to get much stronger with time.
When you say much stronger, what do you mean? Can you quantify that for us in numbers?
Yeah, I mean, the order volume is going to go up. With economies of scale, what we are seeing is our products are becoming more efficient. Operationally, we run the business, we have a great opportunity to take out the white space and even operate at much higher levels of profitability, right? Largely because the technology investments, product investments are driving innovation across a wide spectrum of our established user base. And, the way we also look at our top line business, the way I look at it is that, see, we want to operate the business within a 45 to 50% OPM. And this, for the last 3 quarters now straight, we have been operating at 52% OPM. So as far as I'm concerned, and we look at the business itself, we don't really sweat a lot over how the ARPU is trending down or up or whatnot, because what we look at is the macro picture. We look at the macro number of orders, the macro profitability, and the envelope that which we want to operate in.
So let's get us some macro numbers then, Mr. Gangadhar. You added about 1.2 million new clients in the previous quarter. Yeah. Just wanted to understand at what run rate is this likely to go going forward, and where do you see your overall client base to be, say, 3 to 5 years from now, the rate at which clients are being added?
Yeah, it's a great question. First of all, there is out of all the brokers today in India, there's only a few of us who are actually adding clients. Most of them are not. So see, what has happened is that I expect that the rate of customer addition is only going to increase over the next coming years. I mean, look at this year, right? The RBI has increased interest rates 4 times this year, 4 times. And if you look at the response of the market, it's been very muted. And still, we are seeing clients come in on board and actively engaging in the business and participating. So because our equity participation is just at 5% or even below that, right? Nationally, the country has at least another 8 to 10% of headroom left. So when I look at the next 3 years, I think that as an industry, the broking industry, it's easily going to at least grow, by 3 or 4 times within these next few years, and we don't see any slowdown coming to that end.
Okay, so we are still not getting any numbers from you. So trying to understand, I mean, your client base right now has gone up about 11.1% at 1.1 crores, and the number of orders are around 23 crores. So on that base, what kind of growth do you see for the rest of the year?
So see, the growth that we have seen for this year, whatever growth rate we've seen, for example, this year we grew in terms of client acquisition. See, client acquisition, I expect to continue at the 3 to 4 lakh range is what we have been acquiring customers at per month. Like last month was, I think, 3.9. I expect that to continue through the next 6 months, largely because there's a lot of inflationary pressures coming in, and there's a lot of, there's a lot of pent up issues that are going on the geopolitical scene, which is also impacting India and India's economic fiscal policy. So if you ask me, what do we look at as the run rate? I would say between 4 to 5 lakh, anywhere between 3.5 to 5 lakhs. That's where we are going to be at for the next 4 to 5 months.
All right, we take that point. Just a quick bookkeeping question before we let you go. Your ESOP cost was higher in the second quarter than the first quarter. What is the cost that you expect going forward, the ESOP costs?
See, the ESOP costs, again, to look at as I told you, right, we are looking at the macro level. I think particularly the ESOP costs are going to be within the range that you have already seen so far. But we are in the growth phase. We are not interested in conserving capital. Just to be perfectly clear, we are a growth company. We care more about where the top line is going and how to get to a pole position. And our metric is to operate the business within a 45 to 50% OPM. Now, within that envelope, whether the ESOP cost even goes up by 2x or 3x, it doesn't really matter, because our overall bottom line and top line is going to be maintained for the shareholders and creating further shareholder value. So that's really a macro answer to the question. Micro level, I don't think anything changes within the next quarter or so.
Okay, we'll leave it at that. Thanks a lot for stopping by and giving us a quick update on your business. Well, that's the word coming in from Angel One. The volumes have been at an all-time high. Client base has also gone up, but revenue per client has dipped. So that is a bit of a concern. Let's slip into a quick break. Jay Thakkar of Marwadi Shares and Finance will be joining.
The market's gaining some traction now as we speak. The Nifty is up almost 100 odd points, and while the Nifty Bank is holding with gains of around 440 odd points, it is a bunch of other heavyweights that are contributing to the move that we're seeing in the last few minutes. The first one, we spoke about Reliance already. Now that one's sitting comfortably in the green with a gain of almost 0.75%. Giving it company is Bharti Airtel, another weighty stock on the index, and Infosys. The intraday chart of Infosys comes up for you, and you see that even on Friday when we saw all the IT stocks sell off from the top, now they're coming back in the second half of trade. Infosys has moved to the high point of trade, taking the Nifty comfortably above the 20-day moving average. So good time to get in, the F&O perspective on the market. It's interesting that even as the market's moving higher, nervousness hasn't abated, because the India VIX, usually when the market moves higher, goes lower, but India VIX this time around is higher by about 2.5%. So that's telling you that nervousness is still not out of the system, and the mid-cap index is underperforming. That usually underperforms when there is still nervousness in the system. But, if you're looking at some support levels, put writers are active at 17,100 and 17,000. So what does that mean? That the bulls are expecting support around that 17,000 mark. That's primarily because between 16,950 and 17,000, we've seen a lot of support as well. And technically speaking as well, we have the 200-day moving average out there. But as we speak, the 17,300 call is constantly seeing writing. So that means bears believe that levels upwards of 17,300 may find some congestion. The Nifty Bank has bounced off the 50-day moving average, and Nifty has bounced off its 20-day moving average as well. So those will be immediate levels that we'll be looking at. But now that bears believe that levels upwards of 17,300 would be their terrain, what should we look at? The Friday high of 17,349. Because if bulls go ahead and conquer that as well, then those bears will have to, worry. And cover their short positions, which stand at around 77%. So that is one level that I'll be watching out for.
Okay, well, let's find out from Jay Thakkar of Marwadi Shares and Finance on what his view is on the index. Jay, good afternoon and thanks for joining in. For the market, it seems to be in this range, right? The 200-day moving average on the downside and 17,200 on the upside. Do you reckon that there is any reason for this market to break out of the range in the near term, either up or down? And what are the stocks that you're looking at this afternoon?
Sure. Very good afternoon to you, Sonia and Mangalam. Well, yes, the market has been, trading within this broader range of, 16,800, 900 on the downside to 17,600 on the upside. And within that broader range, we have a short-term range of, 17,100 on the downside to 17,500 on the upside. I believe that, the kind of put writing which we have been continuously seeing now since past 2 weeks. I think that 17,000 on a closing basis will definitely act a very crucial support, as below those levels, as you rightly pointed out, Sonia, that 16,800, 900 range, of which 200 DEMA, will definitely act as a very crucial support. We have a short-term bias positive on the index. And I believe that, till 17,100, 17,000 range on a closing basis is held, at least. For the short term, index is heading towards the levels of 17,550 to 600 range on the upside. Now, the overall bounce which you have seen coming from the levels of, say, 16,850, 900, previously till the levels of 17,400, 420, which you had seen, was a corrective move. That's a three-wave rising pattern, and post which the fall also which we have seen again has been corrective. It's not been the impulsive or a straight fall or a sharp fall. This clearly indicates that the trading range is likely to be intact, at least for next couple of trading sessions. Hence, I believe that again, since Nifty has reversed from the lower end of the range, is likely to inch towards the upper end of the range, that is 17,550, 600. Hence, we have a buy recommendation. As far as Bank Nifty is concerned, 39,500, wherein we have seen aggressive put writing as well, will act as a very crucial support on the immediate basis, and 40,000 and thereafter 40,200. These are his two short-term targets. And as well as on Nifty, we have seen aggressive put writing happening right from the range of 17,000 to 17,200 strikes. Since our short-term bias is positive, we have two buy recommendations. The first buy recommendation is on Punjab National Bank from the banking pack. It's trading at around 36.70 on the spot, and we have a target of 38.70 to 39.50. These are his two short-term targets. One can buy PNB with a stop loss below 35.50. And the second buy recommendation is from the IT pack. Now, we have seen that IT has been recovering now with some positive divergence. So I have a buy recommendation on Emphasis, which is trading mildly negative right now. The spot price is 2098. One can buy this. The targets are quite aggressive. On the upside, the first target comes to 2360 and second target will be 2440. One can buy Emphasis for these two targets and placing a stop loss below 2030.
All right, we take that point. Thanks a lot, Jay, for joining in. A bunch of stocks also surging right now from the broader markets. Container Corp has moved to the high point of trade. IRB Infra has been doing well for the last hour or so, has only extended its gains, now up 9%. And Delta Corp too has come up on the charts as a beginner at the high point for that counter too. Let's take a short break. On the other side, we take our flight to Air India. In fact, an exclusive conversation with...
Welcome back. Here's a CNBC-TV18 exclusive. Campbell Wilson, who's the newly appointed MD and CEO of Air India, tells Shireen Bhan that gaining 30% market share is a 5-year project. He also says that while Air India may look quite different in the future, it can leverage multiple brand assets from a 90-year history, including the beloved Maharaja. Listen in.
So bringing leased aircraft in is one. As I say, we've got some already signed. We're in conversation for more. So yes, it's a 5-year project to get to 30% market share. There's various ways to do it, but we're quite confident, well, we're very confident of doing so. And yes, it's going to be step by step. As I say, all those ones and twos will add up.
Mm-hmm. But in the near term, like 2023, what do you believe you're going to be able to do in terms of improvement, both in terms of market share as well as some of the other metrics that I know you're keen to focus on-time performance and so on and so forth?
Well, the intake of aircraft and the restoration of grounded aircraft will necessarily lead to an increase in capacity. Whether that leads into an increase in market share obviously depends on what other players in the market do. But the things that are under our control, we're putting in place. With respect to on-time performance, Air India didn't have a good reputation, let's be fair. There were many, many reasons for that. Systems, processes, focus, aircraft availability, reliability, all of these things. But I'm pleased to say that since April, when we were 6th in the domestic market, in September, we have finished provisionally first. The results are going to be officially coming out today or tomorrow. So we'll be first or second, hopefully first. And if we are first, that will be the first month since at least 2014 that Air India was #1. We only went back to 2014. We didn't have records before, so it might even be longer than that. But #1 for September.
Just in terms of communication, advertising, marketing, is that going to be a key focus area? What is going to be the brand promise that you now make to customers?
Well, the brand promise has to be substantiated by capabilities, in fact. And so, yes, the future Air India might carry, might look a little bit different. It might represent itself in a slightly different way, but that's something for the future to be determined. Certainly no decision.
Is the Maharaja coming back or not?
Well, the Maharaja is still there. We have many, many assets after 90 years of heritage. We have many, many assets that are at Air India's disposal, and we want to use them all to their best advantage. At the same time as we represent the company in a modern way that represents India in the way India is today and wants to be represented overseas. Nod to the past, but also acknowledge the future and acknowledge who we're competing against. Air India was the best airline in the world in the late 60s. But doing now what we did then wouldn't make us the best airline in the world. We have to benchmark against the best and do what it takes to get there. And there's every resolve and commitment, both from the employees as well as from shareholder. And certainly that's my mission, to make sure we get there.
All right, so that's interesting. You remember, you can catch this entire conversation and excerpts of this all through the day only here on CNBC-TV18. Welcome back. Let's talk about those flashes that we just spoke about a short while ago. Sources tell CNBC-TV18 that the IRDAI, or the insurance regulator, may not take any further regulatory action on Max Life and Axis Bank. Yash joins in with some more details on that. Yash, there was a fair amount of volatility on both these counters, specifically on Max Financial on Friday, and now we understand that there may not be any action taken?
Well, that's correct, Manglam. So the volatility that you just spoke about was on the back of a lot of uncertainty which came with the regulator's order. We have a lot more clarity on what's going to be the future course as far as the regulatory approach is concerned. First thing, to just put things in context, on Friday is when the insurance regulator first imposed a total penalty of 2 crore rupees on Max Life Insurance, which was to be remitted by Axis Bank, which is the promoter company of Max Life Insurance. This order on the weekend, that is on Sunday, was replaced with another order from the regulator where they increased the penalty on Max Life Insurance by another 1 crore, which means a total penalty of 3 crore on Max Life Insurance. Not just that, they also imposed a 2 crore separate penalty on Axis Bank on charges of getting undue benefits from the transaction between Axis Bank and Max Life. Both these two entities, that is Max Life for an amount of 3 crore, Axis Bank for an amount of 2 crore, they're supposed to remit this amount to the regulator within 21 days. Now, the latest that we've been given to understand is that this could be the end of the regulatory action on both entities with respect to the transaction that took place. No further regulatory action is expected to be taken by the regulator. Also, this particular regulatory action which has been taken won't affect the deal which has been executed between the two parties, that is Axis Bank and Max Life Insurance.
Okay, thanks a lot for that, Yash. Well, let's do one thing. Let's take a quick break, but we'll take a breather from equities and talk about commodities on the other side. Manisha Gupta joins in with PR Somasundaram of the World Gold Council.
Welcome back, and joining us now on the show is PR Somasundaram. He is Regional CEO India at World Gold Council. Som, hi, I'm sure you're busy these days understanding on what the trends really are in the Indian gold market, because this is that time of the year when not just India but the global markets also are eyeing India on the buying patterns and trends here. So just a week to go for Diwali. What are you picking up on ground?
Well, demand certainly seems to have been very good during the Puja festivals.
Okay.
And as you know, Manisha, it's always very difficult to give a certain figure. So we have to talk about the aggregate figure that we saw last year and what we intend probably could see this year. As you know, last year, December quarter was the highest ever in the data series, 25 years we have seen, 344 tons. We just didn't expect that kind of a spike because that had a lot of pent-up demand that supported the last quarter, and it was surprising to many industry players as well. This year, I don't think we will see that kind of a demand scenario. However, it is much better than what we have seen in the first half, which was hardly 7% above the same time last year, which was not one of the best half ones. And we have just entered the third quarter and we'll be releasing the figures next week. So it looks like this demand will be better. That's what we are hearing. Puja sales have been good, but the market is still at a discount. So there is a $1 discount I hear, so which tells you a lot about how the the trade looks at things.
Clearly. Last year we all understand it was a pent-up demand, and this is the second straight year of strong buying, as you said, continuing. But if last year was anything to go by, I've been talking to a lot of industry players, and they say even if it is as good as last year, even 5% less than last year, we would still count it on a stronger side. So that really is how the market is viewing it at. But another thing is that we now have a hallmarking, so there's no concern really about purity and condition of the gold that people are buying. But what do you think on how people are going to be buying this? Because when you talk to different players in the market, whether it's about physical, jewelry, minimalistic, simple designs, or digital gold, e-commerce, it is spread really across everywhere. How have you tracked down these numbers?
Well, jewelry will continue to be the biggest buying. There is no doubt about it. 80% will come through jewelry.
Okay.
Certainly during Dhanteras, people do buy coins, but then there are no branded coins in India other than what the jewelers sell. So obviously the organized players will garner a very high market share of that. But interestingly, the other ways of buying gold that you touched upon, digital gold or ETFs, certainly will also see a rise. But in the overall scheme, they are very, very small. The ETF is still about 40-45 tons as a AUM. Digital gold, while it has grown significantly, it is still very, very small. However, they are picking up. There is no doubt about it. There is a lot of interest, particularly in the urban areas, to buy gold on the digital mobile phones. And that you should see a very, very large spike. Still, as I said, the overall figure will be very small as compared with what we see in jewelry.
So we've been talking to a lot of industry players, and they said that global markets are not looking so good with what we are seeing in Europe and some parts in US as well. But the Indian demand, Asian demand seems good. With what we are going through in sense of fundamentals, whether it's about this talk about recession or a slowdown or a rate hike, what do you see impacting the gold prices and demand, if at all?
Well, as you know, in the short run, demand follows the price. I mean, it reacts to price. Demand doesn't determine the price. It is the US dollar strength. And we have seen that there is a certain softness, which despite all that is happening, even the rupee has depreciated, but we still see it is around 50,000 rupees. It hasn't gone to the high we have seen during COVID, which was 55,000 rupees. So in a sense, the consumer will see this price as attractive, no doubt about it. But there is also an expectation when the price is so soft that it will fall further. So you may see some people actually deferring the purchases. In terms of price, what do we see? Yeah, certainly currently the prices are affected by a very strong US dollar and the interest rates. Whether they are able to achieve the objectives of controlling inflation through this is a very important factor to watch out. And if it happens that in the next 2 quarters, this doesn't seem to be the case, you could see gold reacting very strongly upwards.
So I have one final question since we have you with us. Last year has been very eventful for gold, if I can say so. We've seen highs, we've seen hallmarking mandatory, we've seen IIBX being introduced as well, import duty increased as well, not just for gold, but for platinum as well to, plug those gaps there. What are your expectations from the next Samvat, until the next Samvat?
Yeah, you mean in terms of the policy or duties?
In sense of policies overall.
Well, in terms of policies, I think there isn't much that we expect now. I think what needs to be done has already been announced. It is now more of execution. We would definitely look forward to how the exchange work and the exchange actually changes the market. I think it's a very, very fundamental reform that has come through. There are lots of teething problems, no doubts about it. But I would think that that is one thing we will be watching out for. How does the exchange trading change not just the price transparency, but also the entire supply chain, the responsible sourcing, and the general trust that people can have in gold, and the way people can hold gold. And if EGRs, the electronic gold receipts, become available, you could see people actually move from jewelry to holding even, dematerialized gold in a big way.
All right, that could really change the way we deal or do gold right now, but that's for the next year. Until this Samvat, as Som is telling you, yes, there is a lot of buying happening in gold, 80% of that still in jewelry, and Dhanteras perhaps could see coins and ETF, digital gold, you name it, and there's so many ways to buy gold, and if there is backed by gold, then gold it is what you should be buying at. Som, thank you as always for joining us with that whole 360-degree perspective on what the gold markets mean for India. With that, it's a wrap on this halftime report. Business Lunch will take all the action ahead.